G'day everyone, Greg Canavan here. I'm talking with Murray Dawes today. As Woody said in the intro, we had a good chat about 2 weeks ago on whether the market's close to a turning point, and for the next 2 weeks the market has continued to rally, which is an interesting point, and one of the things that I often write about to you guys on Mondays and Wednesdays is the market never really does what you expect it to do. And in the past couple of weeks, we've seen China and Hong Kong come to I guess political blows in China, trying to encroach on that territory. You've seen riots in the US. You've seen a lot of negative news on the headlines, yet the market has just kept marching forward. So 2 points to make about that. The market's either wrong and is just rallying fueled on liquidity, or the market is rightly looking through all these short-term issues and seeing the global economy open back up after a forced shutdown from the coronavirus. To try and answer whether the market is right or wrong and where it's going to go, that's the point of today's conversation. So I'll bring in Murray. Murray's got a couple of interesting charts to show us. He's going to run through the S&P 500 quickly and then take a little bit of time and detail to go through the ASX 200, because from the conversation I was having with Murray and what he's going to show you now, we're at a very interesting point for the ASX 200 in terms of where it's been and what things how things have played out historically. So we'll get into it. How are you going, Muzz?
Not too bad, not too bad. Not the best day. You know, it has been an amazing rally the last few weeks, and I've put a hedge on in my portfolio. We've been long some stocks I've been buying on the way up, and I put a hedge on a little bit early. So, you know, just because you're a trader that's been around for years doesn't mean you find a market that goes down 40% and then up 40% in a straight line easy.
No, it's certainly testing nearly everyone. I should point out we're recording this about lunchtime on Thursday. The market opened up very strongly this morning on Thursday. It's been selling off a little bit though, so it just gives an indication that we are perhaps getting to a point where it's this day after day bullishness is maybe starting to attract some more selling power.
Yeah, well, look, I mean, if people have been watching my Monday videos on Insider, they will know my last one was called Spike and Failure. And that basically said, I think we will see a spike in the US markets up into the major sell zone that I've basically been discussing for months. I mean, I never thought in a million years that it could actually get up there. And now it is. And I guess now I'm really waiting for the failure, and look, that may not come. The market may march higher if coronavirus is on the way out and there's been massive stimulus. You know, the virus will go and the stimulus will remain, and perhaps we're just in that sort of a crazy market where it's going to go vertical, and if it is, fine. But from my point of view of observing markets for the last 25 odd years, the point where it's going up into now is the one where, well, my hands are tied that I can't buy it, and I'm really looking at this from a risk reward perspective as potentially being just a fantastic opportunity to get short. But you've got to wait for the momentum to shift, and that's where we're at now. We've had the spike, and it's and if I can show you.
Yeah, absolutely. I was just going to say, show us that chart, because I think it obviously illustrates what you're talking about and shows that we're getting back into a poor risk reward scenario for the buyers at this level potentially.
Yeah. So can you see the chart there?
Yep.
Right. So this is something I've been talking about for a long time, where I look for these waves and how they develop, and that they shake all traders out. So the way wave development occurs is it'll usually retrace almost all of the previous wave before then continuing on. And that ends up shaking everyone out. So if we have a look at this chart.
And just to be clear, we're looking at the S&P 500 here.
This is the S&P 500, yep. And the first thing to point out is we've got the all-time high here, and this is a monthly chart. So every bar you see there is 1 month's trading. And we've had the crash from up here all the way down to that low there. And for me, the 75 to 87% retracement zone is the area that I have found is where there's a highest probability that there will be a reversal, at least back to that point of control, the midpoint. So we're currently trading in the last bit of trading we've had has actually taken us up into that sell zone. So from here, for me, this is the highest risk spot. This is where everyone's bullish, where all the shorts have been taken out. People think it's definitely going to take out the all-time high, and all of a sudden you can wake up and it's reversed quickly, and the move back to the point of control can be very quick. So just my point on this is, it may keep going fine. If it does, okay. But for my model, I just can't step in and buy this with the market rallying as strongly as it is into that 75 to 87% retracement zone of that whole wave down. And there's another point which I want to make, which is even more interesting for me, is when I look at trend development, and if we look at these waves in this trend, the first sign of the trend potentially turning down is when it breaks below the highest low. Can you hear my dog in the background there? I've locked him out in the kitchen, but he's rushing around.
No, he's hungry, mate.
Yeah, that's it. Is when it breaks below the highest low in that uptrend. So as long as they are intact, the trend is intact. And the crash actually did bust below it and is now rallying. And the way I look at these things is once you get that hint that it has busted below the highest low within that trend, I'm interested once it rallies back into the sell zone of that wave, because that's often the best opportunity. If it is going to turn down in a big way and we've got that hint, your best opportunity is once it's rallying up into the sell zone of the wave down. So from many angles in the US, for me, I'm on high alert actually that this thing can turn down rapidly. So, I may be wrong, and in the last few weeks, I certainly have been surprised by the strength of this rally, but everything I've been talking about in those videos is that this is now the moment where you need to tread carefully.
And do you want to give listeners some sense of what you're potentially looking for in terms of getting the signal from the market that things are turning down or turning bearish?
Yeah, well, I mean, for me, it'd be quite simply like a weekly sell pivot. So to wait for enough momentum to shift where the weekly actually changes, and I'll show you very quickly. So
it's not a matter of just one night selling, is it? You've got to wait for a certain signal.
If we look at, this chart here, and this is the weekly chart, and I just pull out for you and if I just point out the weekly sell pivots and buy pivots, we have the buy pivot is when prices are marching down and then I see the close above the high of that lowest price candle.
Yep.
So that's my first sign. I mean, it needs to do that before it can go up, really. It doesn't. I mean, that's the first thing that needs to happen in an uptrend.
Yep.
Is that we need to see it close above the high of that lowest price candle. And you can see from there, we had a rally for months.
Mm-hmm.
And then we've got a weekly sell pivot there, big sell-off for a month. A weekly buy pivot there, rally, rally, rally. There's the weekly sell pivot there, big sell-off. And this is going through years of data. Weekly buy pivot, a little weekly sell pivot, then a little weekly buy pivot here, all the way to the all-time highs. And then this weekly sell pivot here is when I actually took profits on a lot of stock. And then here's a weekly sell pivot all the way into the crash. And the last weekly buy pivot is actually all the way back here. And ever since, we've been marching higher with what I call the key bars, when we get a weekly close above that next highest bar. So until that changes, it can carry on for a long time. I mean, these weekly trends can last for months. If you look here, going back, these weekly trends can really go on and on. So once they turn though, that's a pretty big sign that there's a momentum shift. So any sort of weekly sell pivot up here, and I'll be getting pretty interested.
Yep. All right, and you were talking that you had some interesting stuff on the S&P ASX 200.
Yep. I'll whip you through that. I think it is really interesting to point this out to people because it is pretty clear when you have a look at it. So if I just bring up the ASX and we look at the monthly, okay, what I want to point out to you is the moving averages. So everyone knows about moving averages, and my key ones on the monthly is the 10-period exponential. So that is the red line there, that thin red line you can see. And the blue one is the 20-period simple. So that's my sort of main one on the monthlies to keep an eye on. So you can see the trend shifting to the upside there, downside there, up there, down there. Okay, so over time, it's been a really good analysis of the really big shifts in trend.
Yep.
Now, what I want you to look at is when we get the 10-period exponential actually failing through that 20-month simple, we often get a retest. So we'll get the sell-off, and then prices will retest that 10-month moving average and then sell off. And we'll do it again. We get the failure. We get the retest of the 10-month moving average and 20-month, and then the failure, which is the crash.
Yep.
In this instance, we got the failure, then we got the retest of the 10-month moving average and a year of terrible trading. And on this one, we got the failure, big sell-off, retest of the 10-month moving average, and then again a retest of the lows over months. Now here we are here with the 10-month exponential has failed. We got the big failure, which was one of the biggest crashes in history. And now we're rallying, and this morning we've opened up and rallied and come very close to that 10-month exponential, which in 20 years on 100% strike rate has been an area where you'd better watch out once that long-term trend has actually shifted. So from that point of view, again, it's in a situation where in 100 times out of 100, it has been an area where the market turns down from, even if it is just going to retest near the lows and turn back up, you're still going to get selling pressure up around that area. So for me, my hands are tied. I can't buy it here on my model.
Well, I guess that's the thing. Your model is giving you too many signals that we could be very close to this turning point. And to bring it back to that conversation we had a couple of weeks ago, I had a couple of charts that I was looking at myself to indicate whether we're sort of bullish, bearish conditions. And at the time, I think I showed the Aussie dollar and hadn't quite broken through.
Amazing what it's doing.
Distance. And in the past 2 weeks, that's had a massive run. So let me just bring that chart up quickly, and we'll have a look at that as well as one other one that I've got here. Let's bring it up. So this one's the Aussie dollar, and look, you can see it's broken up through that 60-cent area of resistance, and the next level I'm looking at just over 70 cents there. My sense is that this is a lot to do with just US dollar weakness, and the US dollar has been very strong leading up to the past past month really, and then we've just seen a lot of weakness in the US dollar. The US dollar is now very oversold. The Aussie dollar is very overbought. So I would be surprised to see it rally too much further from here. And I think, in fact, it is a little bit weak today. I guess the question is whether it comes back down to that 67-cent level and finds support again there. And if you can look at the moving averages that I follow, and this is more of a medium-term trend. You're looking at the 50-day exponential moving average, which is the blue line just about to cross above the 100-day exponential moving average, which is the red line. And that indicates to me that obviously you can see the medium-term trend of the Aussie dollar is starting to turn around there. The reason I follow, as I explained last time, the Aussie dollar, very much a risk-on sort of trade when the global economy is looking quite healthy and there's plenty of liquidity around. Often traders will buy the Aussie dollar. The economic background to that is the Aussie economy is not doing too badly. I mean, the data we had out for the March quarter yesterday, even though it did show a 0.3% headline number contraction, if you look at it factoring in per capita and import-export prices via the terms of trade, we actually kept our head above water by 0.1% in the March quarter. So the economy is still growing, which is saying a lot. Is saying a lot, given that you're seeing big contraction in other economies around the world. So there's fundamental reasons why the Aussie dollar should be quite strong here. But I guess the question is how much of that has just been pushed by these short-term liquidity and stimulus measures that have been put in place everywhere around the world.
Yeah, well, I mean, oil's sort of flying, iron ore, copper,
absolutely.
So that they're all sort of rallying, and we're getting sucked up along with it. And I wonder whether there's offshore money coming back into our market. That they dumped it during the crash, and there's a bit of money sort of coming back into the equities.
Absolutely. I think that's part of it. But what the interesting thing for me is that, the Aussie dollar has rallied well above, where it was before this coronavirus crash started. So we're sort of getting back up into the 70 cent territory. But I think that's a lot to do with US dollar weakness, and I think you'll see the US dollar bull market continue. So my view is this turns back down again very shortly. The question is whether it finds support there at 67. So we'll keep an eye on that for you and follow that up again in another few weeks. Just this final chart I wanted to show. The XSO is the Small Ordinaries Index. This has been obviously outperformed the large cap stocks, and when small caps outperform large caps, it's generally a sign of a reasonably healthy bull market. So this is a real positive sign. But what I want to point out here is that the rally has been so quick and so persistent that it's already getting back up towards where, as you were saying, Murray, this is getting towards a poor risk-reward trade around these levels. It's starting to get close to former support, now probably will turn into resistance. So I can see a scenario where, if you're right, Muzz, and we're seeing stock markets move up into a region where it's going to see sellers come in, then you could get a pretty sharp turn in the small cap space. And I'd be interested to see whether it finds support at that lower green line of drawn there, which is just the lows from 2018. So the point is, like, I think we could well be in a bull market, and purely from all the liquidity that's been created. And I think, as you said earlier, Muzz, whether it was before the call or on it, if the virus goes away and the stimulus stays, then that lends a lot of weight to an ongoing bull market for stocks, purely just from the liquidity aspect. So, I wouldn't get too worried about a pullback. But if you see certain areas of support breaking down, then that's when you'd really question whether this, we're in a new bull market phase. So these are just some charts to keep an eye on. The other thing I'd point out, lately we've seen gold sell off. We've seen bond yields start to pick back up a little bit again, which is generally characteristics of bull market and a market focusing on growth. So whether that is a sign of things to come, or whether this is just the final sort of panic back into the market after we saw a panic out of the market in March, we will find out pretty soon. But perhaps we can schedule in another one of these in 2 weeks, and perhaps in 2 weeks we'll find out where we are exactly.
Yeah, look, if the S&P rallies, up through 3250, we're at around 3100 ish now. So that's only 150 points away, about 5%. But if it does actually bust up through there, I'll be sort of going, wow, that's just quite incredible. I just think after the biggest crash in history, to be up within a month up in near the highs again, I just can't imagine that there's not going to be a bit of a reaction from here, just from what I've seen over a long time of watching markets. So,
well, that's the thing. Nothing's impossible, but you've got to work on probabilities, and the probability is, after such a very strong run up, you would expect to see a bit of a reaction to the downside. Yep,
that's it. So that's why I'm hands off right now. But and the risk reward is, I think, to the downside, that we will ultimately see that sell off. So I guess we'll find out in the next few months whether I end up with egg on my face on that one.
We will, and we'll catch up again in another couple of weeks to have another chat about all this. Murray, thanks for your time, and thanks for all the watchers out there, and we'll catch up again soon.
All right, cheers, mate.